Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, and my colleague Victor,
Well,
who is the other person speaking. Hi, Victor. How are you doing?
yeah, very good. Excited about the latest macro developments, and as usual, I'm going to delve deep into
Yeah,
those. I'll touch later
excellent.
after you walk us through this initial part.
Yeah. I'm gonna walk you guys through the initial part. So this is the live market analysis webinar. It is what it says on the tin. We analyze the markets live. So for those of you who have joined us, welcome to today's webinar, and please help us by asking us questions on any tradable markets with Think Markets. For those of you who are watching this on YouTube, please consider joining us live next time because you will have the opportunity to ask us any questions. Okay, so um, I'm gonna start off by showing you the disclaimer and risk warning. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, this webinar happens every Tuesday, 11:30 London time, and it's mostly technically focused, the way we like it. But with the help of Victor, we do touch on fundamentals as well. And as I said, there will be a Q&A session. But don't hold back until the end of the webinar if you have any questions. Please feel free to ask those questions in the chat box or in the questions box anytime you want. Okay. So what's happening then this week? Well, we've got lots of things happening. We have the OPEC meeting today, jobs report from the US and Canada on Friday. And in between, we have a few other things which could move the FX and indeed indices markets quite sharply, depending on the outcome of those. So obviously the OPEC is the key risk today, and crude oil prices will be in focus. Oil prices have broken out to new 2.5-year highs in the US. WTI crude oil futures have broken out. Brent oil is testing its 2021 highs. So oil prices have been rising because of well, because the market has tightened, hasn't it? You have the OPEC plus, Saudi and Russia and the rest of them restricting supply, and at the same time you have a recovering global economy. The recovery has been stronger than expected, and because of that, demand has been stronger for oil, and so prices have only had one way to go, which is being up. But will the OPEC now decide to ease those restrictions? That's the key risk. Obviously, with Iranian oil supplies coming back, or potential Iranian oil supply coming back. We'll talk about that in later on when we look at crude oil prices. We also have the US ISM manufacturing PMI later on today. Key, one of the key data releases that we watch for the US non-farm payrolls report. So if you look at the ISM manufacturing employment component and the employment component of the ISM services PMI, which is released on Thursday, those will give you an indication about what to expect insofar as the jobs report is concerned on Friday. So don't forget to look at the detail of the ISM manufacturing PMI report. A few central bank speeches, as you can see, starting today with Governor of the Bank of England, as well as a couple of FOMC members. On Thursday, I think we have some more on Thursday, and then on Friday, it's a key day for central bank speeches. We have the president of ECB speaking, Fed chair, Swiss National Bank chairman, and so on. Lots of central bank speeches this week, so we should see the currency markets move a little bit sharper this week. Okay, so maybe you want to take a screenshot of this if save it for later. But we do have this macro event calendar on the website in our week ahead preview, so more detail there. Now then, the way we do these webinars, we share the live charts, and for those of you who have been to this webinar before, you know the format. But most of the time we start off by looking at the dollar index, and that's how I'm going to start today's webinar in terms of the technical analysis aspect of it. We have been seeing the dollar index come under pressure every time it's tried a recovery attempt, and last week it broke this bullish trend line, only for the sellers to come back in around the 21-day exponential moving average, driving the dollar lower. We saw some follow through on Monday, and today we are testing the price support resistance area. I wouldn't be surprised if the dollar resumed lower from here, because we are very close to
Would you be surprised if it rises higher?
I wouldn't be too surprised. Anything is possible, obviously, but given the strength of the downward trend, and given how close we are to these lows, the 2021 low, which was hit in January, is just a spitting distance away now, right? It's in my opinion, it's more likely than that we will see a new low for the dollar index than a big rally from here. So what specifically I would be looking for is this area to hold, leading to further weakness in price action, something like that. Now, depending on what happens once, if and when this 2021 low breaks, then we will have a good idea in terms of what to expect next. So, for example, if we get a sharp breakdown and an equally sharp recovery, something like that, helping to create a hammer-like candle here, suggesting that we have a false breakdown scenario. In that scenario, then I would expect the dollar to start pushing higher from there. So that's the scenario I'm expecting to see, right? But if, on the other hand, we get a breakdown and the market wants to hold below the January low, it closes below that and remains below for a few days, then in that scenario, I would expect the downward continuation to obviously continue for a while yet. So in any case, before I entertain the bullish idea on the dollar, I would like to see this level break down, and then what happens thereafter is going to tell us what the dollar wants to do next. So those are the two key scenarios I'm looking at for. Obviously, an alternative scenario would be if the dollar, as Victor mentioned, starts to rally from here, because after all, we are in a we have started a new month. So there's going to be profit taking and whatnot, and we could see the dollar go up from here. So in that scenario, it will be a case of, if this happens, then that's going to happen. So for example, I have marked out last week's high at 90.44. If that level breaks, that would be the first tentative bullish development, because we will have had a near-term higher high in place. So that would kind of make the dollar index look a little bit more bullish than it has been in recent times. But the key level for me, the line in the sand, is this high here, because that is the most recent significant high that was created before the dollar index dropped, right? So that level needs to break for me to turn bullish. For as long as we hold below this level at 90.90, I would maintain a bearish outlook on the dollar, even if the macro backdrop is looking somewhat more constructive for the dollar, isn't it? Because we've seen improvement in data, and some Fed members have started to sound a little bit more hawkish than they have been in the past. But ultimately, the dollar is right now finding it's coming under pressure because foreign currencies are in stronger demand as investors look forward to more normal times ahead. In the UK, for example, we saw the pound hit a new high before dropping. So this was the 2021 high that was hit in February. We broke through that level, with price continuing our projection from the previous webinars. It hit that level, rallied a few pips above it, and then it dropped. So could we see something similar on the downside for the dollar index? Well, a lot will depend on the euro dollar, because the dollar index is literally a inverse of the euro dollar. And with the euro dollar being so close to its own 2021 high, I reckon that the euro dollar is going to take out that level as well, like the cable has done so, and possibly hit to 125 before we see any real downside pressure coming into the euro dollar. So that's what I'm expecting insofar as the euro is concerned. Nothing has changed from those macro view. We did break this short-term invalidation level that I had drawn in the previous webinar, but look what happened. It dropped below it, and it quickly came back to close back above. So that was a short-term deviation below that support area, this shaded green area, trapping the sellers below that level. So I think now that the sellers are trapped, rates could break out and go higher again. So if I move this up to here, this level at 22.66 was the most recent high hit prior to price breaking down. Now, if people sold on the back of this deviation, most people will have placed their stops above the high of this candle, right? Because that's what you're told to do, to place your stops above or below swing lows. So there's going to be liquidity risking above 122.66 buy stops, and that is where I expect the euro to head to next, to take out those trapped traders' stop loss orders. There's going to be more liquidity risking above this swing high. This was the most recent significant high that was formed in January. The reason I expect that level to be taken out is the way price has approached the highs. Every time it looks like it wants to come back down, the buyers step in and it push they push price to a new high, breaking its most recent high. So we can see a couple of examples here, and another one is likely to be in play right now. We saw the downward move, and now we're going to be probably taking out those people who sold the euro dollar short. So like the cable, I think that the euro is going to break to a new high for the year, and the level to watch is at 123.50. So that's the first key area where we may see some strong selling pressure come into the market. But ultimately, I think over the coming weeks, we could be heading to 125. And the reason I think that level will be hit is because of this longer term chart. This is the monthly chart of the euro dollar. We've broken the bullish trend line. Price is making higher highs on this monthly time frame, which is significant, right? Now 125 was previously touched in 2018, and given that we are very close to that level again, I think it's very likely that we will get there in due course, given the overall bullish structure of price.
Yeah. So from the standpoint of the monthly chart, indeed, it looks like the dollar is on a sustained downward trajectory.
Yeah.
This kind of reminds me of the cycle unfolding between 2004 and 2007. At the time, the data from the US was very, very positive. Everything was great. And the dollar kept depreciating just because inflation was present, and everybody was saying the Fed should do something about inflation, but the Fed wasn't doing that much.
Yeah.
They were behind the curve, and eventually that developed into the housing bubble. And
in 2008,
in 2008, then the dollar started rallying
aggressively.
the cycle was unfolding.
Yeah.
what's going on now is that we have broken through this decade-long move up in the dollar. And yeah, indeed, it looks like the bears, the dollar bears, will prevail until the Fed decides to do something about this. If I were you, I wouldn't bet my money on the Fed doing anything about a stronger dollar. They're not. This is not their policy mandate. Their policy mandate is allegedly price stability. For some reason, price stability means that prices should be rising.
Yeah, prices are rising everywhere except in the measures of inflation that the Fed tracks.
Yeah, actually, on Friday, even those we saw even those rising. With the PCE.
Yeah.
Which is the preferred measure by the Fed to watch for inflationary pressures.
Yeah.
And some people are saying that we're going to see a 4% core CPI rise in 2 weeks' time. So
all right, that's going to be big.
Yeah, and while that rise is happening, the Fed continues to expand its balance sheet. So
that's going to make it even worse.
Will they do what will they do at this point in time? Well, probably just continue on the trajectory that they have been on for the past.
To be fair, the Fed has said that inflation is going to rise above target and remain above it for a while. So it's not something that's not expected.
It's not something that's not
by them. It's just a question of it's just a question of whether or not inflation remains sticky. And if the Fed is proven wrong, obviously their actions are going to cost the economy dearly. High inflation is not a good thing for the economy, but if they are proven to be right, then they're doing the good thing, keeping interest rates low and allowing the economy to revive after what has been a severe economic recession, not just in the US but around the world because of the pandemic. So I think right now that the Fed are doing all they can do, but as Victor mentions, maybe they are behind the curve. But only time can tell whether or not they're, to be fair, their job is really difficult. They have to balance the economy ahead of time, and it's not an easy job, trust me.
Yeah, they have to deflate the value of the US debt.
Yeah.
So anyway, shall we move on to some indices?
Indices, sure. Yeah. I think the FTSE is looking quite interesting for a change. I mean, I have been looking for this breakout on the FTSE for a while, and today it looks like it's finally moved. We had a couple of attempts to break the bullish trend line, but each time it tried to break through it, it closed the day above on the daily chart. So we've been consolidating in this tight range for a while. While other major indices have broken out. So if you look at the DAX, it's been going up, S&P going up, you name it. Any major indices index you look at, they have been pushing higher, except the FTSE. Now it looks like the FTSE has finally joined the fun. Let's see if this breakout can sustain itself above this level at 70-75-ish, which was resistance in the past. So if it can hold above this area now, then we could see a new high for the year, possibly as early as today. Now, obviously today, crude oil prices are higher, as I mentioned. So you have lots of energy companies in the FTSE and commodity-linked stocks that are helping to power those gains. But with yields also remaining near recent highs, in the UK, last week we had a big move up in yields. Remaining near the recent highs, as I mentioned. That's helping to support banks. So banks tend to rise in value when interest rates or interest rate expectations rise. because that's how they make their money. And so it's banks and energy companies that are kind of helping to power the FTSE higher today. And that's kind of been the trend for the FTSE, those sectors, ever since people started to turn more positive about the reopening of the UK economy and the success they've had in vaccinations. So I reckon the FTSE is going to break out to a new high and continue high from there. Are there any other indices that you're keeping a close eye on, Victor?
Well, the DAX is also having a great day and is breaking out to a new all-time high today. So that's something that is worth mentioning. I, absent any fundamental change in the news sphere, I don't see this trend stopping here, to be honest. And this could be at the first day of several weeks of rally.
It could well indeed be.
That's how it looks to me, at least.
It does. No, I agree. It does look, from a technical point of view, a side note here. When the DAX rallied to hit new highs a couple of weeks ago or a month or so ago, what it did then was very interesting. It tried to break down on several occasions, but overall it kind of held near the recent highs. So when something holds near resistance for a while, this what happens is the I'll put it on. So if you look at the relative strength index, the RSI, this kind of gets worked. The overbought conditions get worked off. So the RSI starts to trend lower, but the underlying market, the DAX in this case, does not go down too much. So in other words, the DAX worked off its overbought conditions through time, right? So time elapsed and RSI went down rather than price action. So instead of the DAX selling off to cause the RSI to go down, it did that by consolidating. And this is what we call a bullish consolidation. Consolidation just ahead of resistance. Usually, but not always, you get a breakout from that type of consolidation. And lo and behold, this is what's happened today.
Yeah. Do you think this is the reason why gold and silver are pulling back today?
Could be part of the reason. Obviously, gold being seen as a risk, traditionally being seen as a risk-off asset, right? As a safe haven asset. So when stocks go up, gold tends to go. Recently, though, the correlation between gold and the stock markets have been positive.
It kind of broke.
Yeah. So I don't think this is why the price of gold has gone down. It could be a reason why, but I think in the case of gold is just profit taking and the fact that we've seen a little bit of a rebound in US yields today. So if you look at the US yields, they have gone up. When yields go up, this rises the opportunity cost for holding assets that pay no interest or dividend, such as gold and silver. So people are less keen on holding onto an asset like that, and instead they're putting their stock money into the stock markets today, as we've seen the evidence from the FTSE and DAX breaking out. Overall, though, the chart of gold looks bullish now that we are talking about it. It's continuing to make higher highs and higher lows. Nothing's going to rise in a straight line. You're going to see the markets retreat, and I think that's for as long as the Fed remains dovish and for as long as the dollar remains in a downward trajectory, the path of least resistance for gold continues to remain to the upside. So I think future dips will continue to be bought until something fundamentally changes from the Fed. um, which means, therefore, I think gold is going to possibly rise to a new all-time high. It's a big statement to make right now because we are a significant distance away from the record high, but there's nothing fundamentally, in my view, to stop it going there, because central banks like Fed, they are still printing money at full throttle, and that money is going to find itself in gold and indeed in other markets. In fact, there are people who talk about cryptos, having potentially topped out. We've seen Bitcoin come down really aggressively. Um, there are some people who think that the money from Bitcoin and other cryptos getting coming under pressure. People are selling their cryptos and moving into gold and silver. Uh, that's another argument why gold and silver could be headed higher. But with the case of silver, I think silver is looking really strong, guys. I really do, because silver is doing what the DAX has done in the last few days. So if I go back to the DAX, I showed you this bullish consolidation here.
Yeah.
This is only like April, right? But if you go back to gold, silver, it's been consolidating since the middle of last year without giving back too much of its gains. So if I zoom out a little bit and show you a monthly chart, that consolidation looks like this on the monthly. And what I'm going to do is, if I pull my fibs and plot from the low to the most recent high, which was hit in August of last year, you can see that the retracement has only been to the shallow 38.2 Fibonacci level. It didn't even pull back to the 61.8 or 78.6 retrace. Yeah, a lot of people were presumably waiting for silver to hit this level to look to buy silver, because that was the breakout level that we broke through in July of last year. It didn't really come back down all the way there, but what it did is it consolidated for several months.
Yeah.
And now it looks like silver is potentially gearing up as we zoom into the weekly time frame to potentially break out to the highs again. Now, silver, unlike gold, has not hit a new record high. Gold hit its record high last year in August, and it surpassed it by a bit before coming back down. Silver's record high at $50, at just shy of $50, was hit in April 2011, and we are about halfway there after the rally that we saw from March 2020 low. So I reckon silver has a lot of catching up to do with gold to the upside. So if I pull my fibs from this high to this low, you can see that we're not even at 50% retracement of that big drop from 2011. So yeah, silver is looking really strong, I reckon, and I think that is going to break to the upside. And if you think about silver, it's got more uses than just being a precious metal. Silver is used in industrial processes, in renewable energy, for example, electric cars, in solar panels. There's going to be lots of demand for solar panels and the like, as the world economy moves towards cleaner energy in the coming years. And so demand for silver is going to rise, I think. And the beauty of silver now is not just that fundamental demand, but the technicals are looking positive as well. It's spent many years in consolidation around $16-15 before breaking out last year. Now that it's broken out, you're seeing a bullish consolidation, and I think is going to break further higher for all of those reasons. So yeah, the initial target as we go back to the daily is $30. That's where it previously stalled.
Yeah.
I reckon it's gonna test that level, come back down a little bit, and then go on to stage a major breakout. Do you have any other views on gold or silver, or opposing views? I'd love to hear those.
Well, I don't like from the perspective of macroeconomics. Again, the Fed keeps expanding its balance sheet,
Yeah,
so I don't see any reason for precious metals to be declining in their value
yeah,
in the long run. Until that stops, I wouldn't be looking to. Well, also you mentioned the yield on the 10-year. That
yeah,
is usually affecting somewhat the price of gold.
yeah.
It's not a direct correlation,
No,
as you can see. Like higher yields actually have pressured the
they
gold
have. Let
market
me just put that on while we
in
talk.
initially this year.
Yeah,
However, as the rally stopped, as the sell-off in bonds and rally in yields stopped,
yeah,
the the gold market recovered and is currently well. We have seen this pretty strong rally in gold,
yeah.
which is you know. Probably close to 15% from the bottom. I don't know.
It looks like that. Yeah, I mean, we can. There's a tool here that you can see the price range from this low to here.
Yeah.
It's risen about 50. Yeah, just about
Oh
15,
wow.
14%.
I'm
Yeah.
so good with math. So anyway, the this 15% rally without any meaningful correction
Yeah.
could end at some point. I'm not
Yeah.
saying it's going to end now,
Yeah.
but pullbacks are possible,
Absolutely.
and don't be really one-sided on this market.
Yeah.
If gold declines, I don't see how silver won't correct
Yeah.
at least a little bit. So
Sure.
while it has been outperforming over recent weeks, I don't see this continuing very long.
Yeah.
So
So while you mentioned the 10-year US yields, I plotted this the inverse of yields on the chart of gold. So um, the orange line shows the 10-year US bond yields inverted. Okay, so if it's falling, it means it's actually rising. But because of comparison purposes, I've inverted it so you can see the relationship between gold and bond yields. So in other words, the inverted bond yield is effectively the same as bond prices, right? uh, so when bond prices fall, gold falls. When bond prices rise, gold rises. So when bond yields fall, gold rises. Do you get it? So the correlation is actually, it looks visually very strong, which is underscores the need to keep a very close eye on the 10-year US yields, as Victor mentioned. Because in the past, gold has tracked yields very closely in the opposite direction. We have seen a bit of
yeah,
deviation in recent times, though. Yields have remained near their
yeah.
recent highs,
Yeah, but gold has
but gold
rallied.
has
So
rallied. So, could gold correct itself? That's a possibility. Or could yields correct themselves lower?
yeah,
That's
so
another possibility.
basically, yeah. I mean,
So
it's
yeah,
we never know which way this
yeah,
correlation might get restored.
yeah,
Correlation exists to be broken.
Absolutely.
Generally,
Absolutely.
one should never base his or her investment decisions on correlations, because
Yeah.
they are
They're not,
something
not
that
never perfect. Yeah.
exists until it doesn't.
Exactly.
So
Exactly.
yeah, let's move on and
Yeah.
take a look at that gold for sorry, at oil for we had a new
Mm,
recent high plumped in the US
yeah.
crude oil market,
Yeah.
and the market is currently hovering just below that recent high
Yeah.
um, that we marked today, and we broke through the March high, and looking for the close, which is becoming very important. Uh,
Yeah.
the OPEC meeting that is probably going to forecast a resurgence in demand. However, let's not forget that this resurgence in demand comes with resurgence in supply.
Absolutely.
So um, we're still waiting for developments on the Iran front.
Yeah.
Iran is still embargoed, and they cannot export oil, at least not to uh, the bulk of the
Yeah.
global economy. But yeah, this is probably some a key juncture for the oil market. It could the weakness in the dollar might be playing a bigger role here than many expect.
Yeah.
So let's see how this continues.
Absolutely. So let's see. Indeed, I mean, from a technical point of view, this shaded gray green area is now going to be our key area of support, because previously it was resistance. Um, it's not a perfect. I don't know. I should probably include this high as well in there. Um, it needs to hold above this area now. Okay. And now that we've broken above it, we have that reclaimed trend line coming in there as well. So for as long as this holds, I think there's no point in expressing any bearish views on the oil price until the charts tell you otherwise. Even though both myself and Victor, we've talked about crude oil previously, we are getting closer and closer to the time we feel that oil prices are going to peak, because supply of oil, as Victor mentioned, is going to come back um, strongly, not just from Iran possibly, but also from shale producers, because higher oil prices attract fresh supply. So there's that you need to take into account. But right now the market is very tight. The demand recovery has been very strong, stronger than expected, and supply has been restricted by the OPEC Plus group, which has resulted in global crude oil stockpiles to fall sharply. So the glut that was built during the pandemic has now effectively been eradicated, and this is reflected in prices rising, price of oil rising. But as we mentioned, the top could be near, but we're not going to kind of preempt the high being formed at any particular level. But couple of levels to watch are those key psychologically important handles, like $70 on WTI. If you look at Brent has broken 70 already. It found some resistance earlier this year around the 2020 high, which was here at around
Yeah.
71.30ish. So you can see that these kind of levels have been historically strong resistance. Doesn't mean it's going to be the case this time, but could we see some strong selling coming to these areas? Absolutely, it's possible. So going forward,
Yeah.
I think you have to be careful if you're still bullish on oil. There was, a good opportunity for lots of investors to get on board crude oil when prices had dropped significantly last year. Now I think that trend has matured, and a lot of funds will probably be looking to reduce their holdings of crude oil futures, and other tradable products. So we may see some selling come into crude oil prices. But then, from a technical point of view, what you need to see is for price to make lower lows and lower highs before expressing any short positions or short views on crude prices. Keep an eye on the high that was hit earlier this year at 71.36 on the Brent chart. For example, if you see a rally above this level, which looks very likely, but then we could get an immediate rejection that takes prices back below this support area. That would be really bearish. So that would be the bearish scenario that I would be looking for in so far as Brent is concerned.
Guys, I wanted to ask you for questions.
Yeah.
We are towards the end of our webinar. Do you have any particular assets or currencies that you want us to comment on, or shall we move on to cryptocurrencies and just note what has
Yeah.
been happening on this front over the past
Yeah,
couple of days?
I think let's do that while we wait for questions. If there are no questions in like 5 minutes, then we can end the webinar. So we can talk about cryptos now. Now, Bitcoin has had a 50% correction from its 2020 low. So all the other markets, they have continued to rally since bottoming out in 2020. Bitcoin has crashed 50%, lost 50% of its value from the highs.
Yeah.
Now, the key question is it cheap enough for people to step back in aggressively at these levels, or is there going to be more downward pressure going to come for Bitcoin and other
I don't
cryptocurrencies?
know. Are you ready to pay $36,000 for some magic internet money?
Well, that's the thing. There are those that still don't believe in the crypto markets, and there are some that absolutely believe in it and think this is the future of currencies. Um, they don't believe in fiat currency, and they would be more than happy to see this kind of thing happen because they think that prices are now 50% cheaper. They can buy some more. But what is price action telling us? Is it telling us that prices want to go higher or lower? Well, usually when prices drop like this, usually you'll see a period of consolidation, and then we see a subsequent breakout or breakdown. In this case, we haven't seen that breakout or breakdown happen yet. Prices are
Yeah,
continuing to coil inside tightening ranges.
yeah. However, volatility did decline,
Yeah,
didn't it?
yeah. Volatility has gone down.
So that's something that
That
is
may encourage people. Yeah,
positive.
yeah.
Yeah,
So we are bang in the middle of that consolidation zone right now. So if Bitcoin is going to come back, I think these are the type of levels that we going to see prices rebound from. So it's already had this correction. It's consolidating now. Volatility has gone down as we consolidate, as Victor mentioned, and we're bang in the middle of the recent range for Bitcoin. So we obviously it's best to wait for price to tell us if it indeed has bottomed out before we step in. But obviously that depends on the type of trader you are. If you believe it's going to break out, then there's no point in waiting. But if you want some extra confirmation because you're a more conservative type of a investor or trader, then perhaps waiting for confirmation is not a bad thing, even if it means buying it slightly higher than where you can do right now. if you're bearish still on cryptos and on Bitcoin in particular, you can obviously trade Bitcoin short. Just take it from one level to the next because we've already had that big move down. Okay, so don't expect too much further downside. I mean, it could happen, but just try not to expect it to go to zero because it's never going to go to zero. So the best the bears can get from here is probably if price breaks through this potential support and takes out this short-term bullish trend, is the best they can get right now is probably liquidity resting below 30,000, and we may see a bounce at the 61.8 Fibonacci retrace. Something like that is the best I could think of in terms of bearish scenario.
And a false break lower.
Exactly.
Yeah,
Trap the bears below and then rip their
yeah.
faces. So that's obviously a potential scenario. I'm not saying this is was necessarily going to happen, but it could well play out like this. Or
Yeah.
alternatively, we could see a break above the trend line, above 40, and if it can hold there for a few days, then boom, it's gonna potentially start trending higher again, and that would be the
So
potential
what
bullish
about
scenario.
Ethereum? It has been faring a little bit better than Bitcoin
Indeed,
when
it has.
we
Yeah.
look at the longer term chart.
Where is Ethereum? Okay. It has, but it's also in consolidation, isn't it? It's not really moved outside of that consolidation range yet.
Yeah.
Yeah. So this is the weekly chart of Ethereum. Oh, sorry, this is the monthly. This was the weekly.
Yeah.
It's kind of held where it should have, right? This was the last downward move. If
Yeah.
you plot your a level here,
The
last downward move.
support at
Yeah,
2000 to 1700 held.
call it 2000. Yeah, just for
Yeah.
argument's sake. So yeah, that was a key level of support that should have held, and so far it's doing okay. We had a weak inside week there. This week has started positively, and it's doing okay. I mean, support. I was looking at this hammer candle previously. If I circle it, see this hammer. This is what I liked about Ethereum that we didn't see on Bitcoin. Unlike Bitcoin, Ethereum actually did create a low and broke the low. You see that? It broke that
Yeah.
low, but failed to hold. So this is what I wanted to see in Bitcoin. It didn't really break the low. It created the low,
Yeah.
it came back down, got really close, but didn't go down. Ethereum broke that low, then closed back above, creating this hammer candle. And since that hammer was formed, if you mark out the high of that hammer, we got a test of that hammer candle a few days later, right here, and it bounced. I shared this chart, by the way, on my Twitter feed. If you before this happened, then we had another go at it. Deviated for a while below, but then it broke higher again. So far, the bulls are stepping in where they should be stepping in on this crypto. This was the high from a few days ago, the last bearish candle. We broke that yesterday, and now it's being tested as support. So somewhat more positive price action on Ethereum than on Bitcoin, certainly. Right. Victor, can you see any questions? I can't see any questions.
No,
No?
no questions so far.
Okay.
So I guess this is going to be it
Yeah,
for this week from us. And
indeed. And yeah, so for those of you who enjoyed this webinar on YouTube, please make sure you like and share our videos because that will encourage us to produce more content like this. And make sure you join us next time live. So you can do that by going to our website, thinkmarkets.com. Go to market analysis and live webinars. You'll see all our upcoming live webinars in the next page. My internet's not really working right now, or maybe it's the browser. But anyway, you'll see a list there of the upcoming webinars. Make sure to sign up for the next ones. So until then, thank you so much for joining us, those of you who did join us live. And we will see you again next week. Take care.
Thank you. Take care. Bye bye.